For most of the 1990s, this company reported record profits, quarter after quarter bigger than the last. Investors called it the most innovative company in America. 6 years running. There was just one problem. The profit was real on paper. The cash behind it was not. Every fraud is a clock. And this one started ticking the day the company was allowed to call a promise of money the same thing as money itself. The company was Enron. At its peak it was worth around $70 billion and employed 20,000 people. Little more than a year later, it was the largest bankruptcy in American history. And the strangest part is that the single thing that exposed it was sitting in plain sight the whole time in the company's own financial statements. Anyone could have caught it. Not an accountant, anyone. Put the profit statement next to the cash statement, and the proof was one number, sitting in the company's own filings. This is how a company announces a fortune it never held, and the one number that was always going to give it away. To understand Enron, you have to understand one accounting decision, and it has a date. The clock started on January 30th, 1992, when the SEC told Enron it would not object to something called mark-to-market accounting for its energy trading business. On its own, the method is ordinary. What Enron did with it was not. Normally a company books revenue when it actually earns it, when the cash comes in. Mark-to-market let Enron do something else. The day it signed a 20-year contract, it could estimate all the profit that deal might make over those 20 years, calculate what that stream of profit was worth today, and book that present value as profit, now, before a single dollar had changed hands. You can already see the trap. Once you've booked 20 years of profit on day one, that deal is finished. It can never give you profit again. So next quarter, to grow, you need a bigger deal. And a bigger one after that. The accounting didn't just measure the future, it spent it. And there was a second problem, quieter and far more dangerous. A booked profit is not the same as money in the bank. Enron could report a brilliant year and still have very little cash to show for it. The gap between the two, profit on paper, cash in hand, opened in the early years. It never closed, it only grew. So where was all the cash? A journalist at Fortune asked exactly that. In March 2001, Bethany McLean published an article with a simple title, Is Enron Overpriced? And a simpler question inside it, how exactly does Enron make its money? She noticed that for all its reported profit, the company was generating strikingly little actual cash. She was not alone. A short seller named Jim Chanos had spotted the same thing and bet against the stock. Their red flag was not complicated. It was the one anyone could check. The profits kept climbing and the cash didn't follow. Enron's answer was that outsiders simply couldn't understand its business. That was the answer, not the numbers, the mystique. By 2001, the gap had grown so wide that Enron had to disguise it. In the second quarter of 2001 alone, of the roughly $1.3 billion, it reported as cash from operations. Regulators later found about $1 billion came from a kind of transaction called a prepay. Money it had borrowed, dressed up to look like money it had earned. The company was now manufacturing the one number that was supposed to be unfakeable, cash. To keep the paper profits growing while the cash stayed flat, Enron needed somewhere to hide the losses. The deals that didn't work, the debt it didn't want investors to see, it built that somewhere. Hundreds of them, in fact, and it ran them through its own chief financial officer. So it built boxes to put them in. The rule Enron exploited comes down to a single number, 3%. If an outsider put up just 3% of a separate entity's value, and truly kept that money at risk, Enron could keep that entity's debt off its own books entirely. 3%, that was the whole wall. Enron built hundreds of these entities, and the deals that brought it down couldn't even climb that low wall, honestly. One of them, called Chewco, was supposed to have independent outside money. It didn't. The 3% was quietly funded by loans and propped up with cash collateral, which meant nobody was really at risk. Others, run by partnerships called LJM, were managed by Enron's own CFO, Andrew Fastow. He sat on both sides of the deal, negotiating for Enron and profiting from the other side. The board knew and approved it anyway. And then came the part that should have been impossible. To stop its investment losses from showing up, Enron set up entities, the Raptors, to hedge those losses, but the thing backing the hedge was Enron's own stock. So when Enron's investments fell and its stock fell at the same time, the hedge collapsed with the company it was supposed to protect. Enron was, in effect, insuring itself against itself. The committee that later investigated put it plainly: these vehicles existed to avoid the rules, not to take on real risk. So who was supposed to catch this? Two groups, and both looked away. The first was the auditor, Arthur Andersen, whose job was to certify that Enron's books were honest. But Andersen didn't just check the numbers. It helped design the very structures it was signing off on, and earned an extra $5.7 million in fees for that advice, on top of its audit pay. It was in part checking its own work. When investigators began closing in the autumn of 2001, staff at Andersen's Houston office destroyed a large volume of Enron-related documents over a period of weeks, before a lawyer's instruction finally told them to stop. A jury convicted Andersen of obstruction, but 4 years later, the U.S. Supreme Court unanimously threw that conviction out, ruling the jury had been instructed wrongly. By then it no longer mattered. The firm had already collapsed, and roughly 85,000 of Andersen's own employees, people who had nothing to do with Enron, had lost their jobs. The second group was inside the company. In August 2001, a vice president named Sharon Watkins wrote to the chairman, warning that the company risked unraveling over its own accounting. She had read the same statements the public could. She just believed the numbers instead of the mystique. By October, there was nothing left to hide behind. Enron took a $618 million loss in a single quarter, and wiped $1.2 billion off its own shareholder equity, correcting an error from the very structures that were meant to make it look strong. A planned rescue merger fell apart. On December 2, 2001, Enron filed for bankruptcy, listing $63 billion in assets, the largest corporate failure America had ever seen. The people at the top got out first. Through 2001, well before that autumn, executives had already sold tens of millions of dollars of Enron stock. Kenneth Lay alone sold what the SEC later called over $90 million in unlawful proceeds. The employees didn't get the chance. For about 2 weeks that autumn, as the stock collapsed, their retirement accounts were frozen. They couldn't sell. More than 20,000 of them had their savings tied up in Enron's retirement plan. Roughly 63% of that plan was the company's own stock. Over $1 billion in retirement money simply vanished. The courts filled in the rest, carefully. Andrew Fastow, the CFO, pleaded guilty, cooperated, and served 6 years. Jeffrey Skilling, the CEO, was convicted. The Supreme Court found one legal theory against him improper, but his conviction stood, and he was resentenced to 14 years. Kenneth Lay, the founder, was found guilty by a jury, and then died before he could be sentenced, which under American law erased the verdict. In the eyes of the law, he was never convicted of anything at all. Investors lost on a scale measured in the tens of billions. Years later, a settlement returned around $7 billion to shareholders, a fraction of what was gone. And the thing that brought down the most innovative company in America was never exotic. It was the oldest question in business. A profit is a promise. Cash is the proof. Enron had the promise, and never the proof, and that was knowable from the first day by anyone who asked to see the cash. 7 frauds, 1 clock, money, a phone call, code, a machine, a signature, a coin that was only a number, and now a profit that was never cash. The pattern never changes. Only the thing they ask you to believe in does. There's always a next one. Thanks for watching Quiet Loops.